Now, despite political headwinds in the Senate, the government's pressing on with its plan to hit those with more than $3 million in their superannuation fund with a 30% tax on earnings. What surprises many watching on is that the government isn't wavering in the way that assets in self-managed funds are valued and then taxed. A pretty simple example is that, say, a fund owns a property or maybe a farm that goes up in value, so tax has to be paid. The question is where the money comes from to pay that tax if the asset is not sold. Peter Burgess is the Chief Executive of the Self-Managed Super Funds Association, the SMF Association, and joins me from Adelaide. Peter, this is a fundamental issue. Why is the government not listening?
Well, it is. You're right, Ross. It's certainly frustrating for us. We are disappointed that the government is pushing on with this measurement of earnings for the purpose of this new tax. Including unrealised capital gains in this calculation of earnings is really a first for the Australian tax system, taxing unrealised gains like this. It's a fundamental shift in the way that we tax income in this country, and whilst this particular measure is targeting superannuation members with very high balances, it sets a dangerous precedent for future tax reform.
Is it almost trying to imagine that every super fund's the same? Because if you think about, a big industry fund, all of the assets are there, they're valued on an annual basis, and therefore the return comes out, the tax is paid, all of that sort of stuff happens. But, in self-managed superannuation funds, it's the problem of the illiquidity that seems to be the real issue here.
Well, that's right. You think about primary producers where they have, we know a significant number of farms are owned by self-managed super funds, and they have very large land values and a very cyclical cash flow. So, they could well find themselves in situations where they have to pay tax on the increase in that land value from the year before, and they just don't have the cash flow because we're talking about unrealised gains here. So, we're talking about if the value of that land goes up, then that's considered to be, and you haven't sold that land, that's considered to be an unrealised capital gain. You don't have the cash for it because you haven't sold it. It's a paper gain. And so the way this tax will work is that in the next year, you could find yourself with a tax bill and you just don't have the cash flow to pay that because it's based on an unrealised capital gain. So, so that's the real issue here. It's the liquidity problems that it could well create for, a significant number of individuals that hold real property in their self-managed super fund. It's not just farmers. We know there are lots of small business owners that own their business premise in their self-managed super fund. So, and this tax bill could be quite significant every year. It's based on the increase in the value of your assets during the course of the year. So it could well be a significant amount of tax that you have to pay, and you just don't have the cash in the fund or even outside your fund to pay that tax.
So who actually values these assets? Because after all, who determines what the price of a farm or a small business might be? For a small business, for example, it's always the price that somebody's prepared to pay, not necessarily what you think it's worth.
They are required to do that. Sometimes they need to go out and get an independent valuation to justify the value, but the obligation is to ensure that the assets of their fund that are disclosed in their financial statements of their self-managed super fund are valued at market value. So, and of course, these funds are audited every year. That is an obligation as well, that every self-managed super fund is subject to an annual audit, and that's something that the auditor is looking for to ensure that the value that has been assigned to that particular asset in the fund represents market value.
In the broader community, there's not likely to be a whole bunch of sympathy for people with more than $3 million in the super fund. This is something that the Assistant Treasurer, Stephen Jones, has been really harping on about in recent times. But you make the observation that even if you have less than $3 million in your super fund, you should be conscious of this tax, of these rules. Why is that?
Well, you could have scenarios where your balance is below $3 million, but you invest in a particular, it could be a startup company, for example, that has a very significant increase in its share price over the next 12 months. And as a result, you've gone above that $3 million threshold. You could find yourself having to pay tax under this measure. And of course, in the next financial year, it could drop in value, it being very volatile, some of these investments. And you could find yourself below that $3 million threshold and having to still pay pay this tax, even though you haven't realised that gain and possibly never will realise that gain because it's gone down in value in the next year. So you're having to pay tax based on the fact that it's gone up in value in the previous financial year. It's based on that unrealised gain, and this is the problem when you try and introduce the concept of unrealised gains into this concept of taxable income. You get these bizarre outcomes and unintended outcomes in our view.
I'll tell you what, Peter Burgess, good to have you on the program, the Chief Executive of the SMSF Association.